Welcome to Property and Investing with Grant and Charley, the place where we give you access to all the strategies, tactics, and tools to become a successful property investor. You will see that Charley is not actually next to me. I've booted him from the podcast. No, I'm just joking. Charley and Aaron Whybrow, our lending specialist, have actually done an episode together whilst I was away on New Year's, enjoying myself on the sunny beaches of Melbourne. So I am just doing the intro, and then I'm going to kick it across to them. I just want to let everybody know as well, if you do want to be notified every single time we release one of these episodes, but also get access to any of the resources that we do come out with, the best way to get onto that list is head over to propertyandinvesting.com/newsletter, put in your name and email, and we'll let you know every single time we drop one of these episodes, as well as some more resources. Now, before I hand it over to Charley and our guest Aaron, let's cue the disclaimer.
It's Charley here from Property and Investing, and I need to let you know that Grant and I and the Property Investing team are in no way, shape or form qualified to give you financial advice. We strongly encourage you seek out and use professionals when comparing investment products or making investment decisions. All right, today's a very different episode, most notably because there's no Grant. Now, Aaron, does it feel a bit lonely without Grant?
Well, we always miss Grant, but this episode's going to be awesome anyway.
Well, I tell you what, if it ends up a little bit better, we might not actually have him back. We'll have to see it. Now, for everyone tuning in, today, what we're actually going to be discussing is the mortgage rate cliff. Now, for myself personally, one of the things I've really noticed is this is a topic the media are driving hard with a bit of doom and gloom around it. This is something where I almost feel they're, if it bleeds, it leads. They're really, exaggerating? Is that the word? I'm not even sure that's the word. Exaggerating, that's the one I'm after. Yeah, to make a point and really just drive views and clicks online. Where I thought it'd be really great today to bring on someone who actually is experienced with lending and can explain it a bit better than what is perceived online, and that's Aaron. Now, I do have to disclose, Aaron is a sponsor of this show, and he's also my mortgage broker and Grant's as well. So we do have to indicate that we use Aaron's services, and he does come on this show as a sponsor as well. We are biased, but he's damn good at what he does. So Aaron, could you please let our audience know who you are and what you do?
So I'm Aaron Whybrow. I co-run a business called Diagnostics and Finance. We are a boutique mortgage broking firm. We specialize in strategy around mortgage and property investing and the right structures of the lending to enable you to buy your properties at your own pace. I do play the bagpipes. So being a complex instrument, it does help me unwind and relax, but it is related to the mortgage broking area because it's such a complex instrument. Most people look at mortgages, they look at it from afar like the sound of a bagpipes, and it's really cool. But when you get up and close, there's breathing, there's movements, there's a whole range of artwork that's in there, and it's similar to mortgage broking. We're trying to get the right lenders, the lenders that are going to give us the right borrowing capacity and plug in what you need for your property portfolio.
This is a really interesting topic in itself. I really feel like many investors treat mortgage brokers like commodities, like one is all the same. And as I've gone further in the journey myself, I've really come to understand it's actually like there's a bit of art to this. It's like art and science, like being strategic in which banks have what products, when they're used or can be used, and then the impacts on future things. Like it's a continually readjusting Rubik's Cube to be solved. It's very, very fascinating in that way, and we might even do a whole episode on that in itself. But Aaron, I want to stick to this topic because when I first heard about the mortgage rate cliff, I won't lie, I adjusted my risk profile. I'm not sure I slept well that night, which was actually after an ABC video. Just to bring everyone onto the same page, can you please sum up in as simple terms as possible, what is the mortgage rate cliff? And we'll start with that. What is the mortgage rate cliff?
So the mortgage market has two products out there. One's the variable rate and one's the fixed rate. And in the last 2 years, the fixed rates have been taken up in enormous amounts because we had record low interest rates. And having a fixed rate that is a low level and then having a variable rate which fluctuates, What's happened in the last 8 months is the interest rates have risen from the variable. So variable people are paying more and more as the rates go up. Obviously, the banks are getting a bit more competitive with their margins, but the fixed rates have been remaining the same, and they'll remain the same until they expire. And if the rates keep going up, when that fixed rate expires, the next day, the borrower that has had a fixed rate will be on the standard variable rates at whatever discounts they're able to achieve. So they may start going from, say, 2.69 or 2.29, or some cases 1.99, and then jump up to the 5 or 5.5 or 6.5, wherever the rate lands at the time during the next 12 to 24 months. And that's where the cliff comes in.
Yeah, this is where the cliff kind of like analogy comes into play here, or the idea behind it. It's
That's
really
right.
fascinating to me because it's a complex thing that's unusual. And we had this chat previously where we were talking about, like, what's the difference in normal times here? So we'll call it in the pre-pandemic times. You had mentioned that the balance between variable and fixed was how much roughly? Like, let's just say if you went back 5 years, what would the balance normally be between the two products?
Well, if we look at it over the last little while, so we're going to see that next year, 1/3 of all loans are fixed, and 2/3 are going to come off that fixed. And that, if we look at the stats between March 2020 and December 2022, the increase of fixed rate take up was massive. And back in March 2020, we only had about 15% of loans taken up as fixed. Then when we moved into June 2020 area, it jumped up to 35, peaking in June, July, and September 2022 at 45% of all new lending was fixed. So it sort of sits around that 15% area, 25% area of people taking up fixed. And what's really interesting is that if you look at the history of interest rates, the 3-year fixed rate and the variable rate usually run quite similar to each other. And the 3-year and the 5-year are probably the most common that people will take out when they choose a fixed rate.
Yeah, it's a fascinating topic. So it's not only just the jump in rate, but it's the volume in people that are going to experience this jump in rate, which again makes it the cliff, right?
Yeah.
If it was only 10% of loans that were suddenly going to go from, let's say, 2% up to 5%, don't get me wrong, still impactful, but for it to be above 30% in this environment really changes the amount of households that are going to experience like a significant change to their household budget. So really, really fascinating stuff there. Now, by chance, just to really, I suppose we'll make this more interesting. I know you've prepared some numbers here. If someone has a $500,000 mortgage and they'd been on a really good fixed rate deal, and then suddenly this change was going to come in, what's the difference in like their, let's say, their monthly or weekly mortgage payment going to be?
So if we take we'll take the 2.69 fixed rate, because that seems to be a more common one that I'm finding coming off, and some of the lower ones. But if we pick on this one, a $500,000 loan at 2.69 is $2,025 there and 35 cents a month. As that loan comes off a 2-year fixed rate, the remaining 28 years of that mortgage, one of the best rates that we've got today, being the 30th of the 12th in 2022, is 4.54, which means if it's your own place, this is on your own place, so owner-occupied rate, would be $2,545.32. So that's an increase of $519 a month. And if we go down the line of fixed rate on investor and we take the 2.69 and we jump up to the 4.86 or even 5.14 at some of the other, between that range at today, the 30th of the 12th, that would increase your repayments between $700 and $700 a month and $784 a month, which would translate down to about $161 to $181 a week increase in repayments on that mortgage overnight. So that's what that's what we're in for, and that's what we've got to prepare for as our rates come off fixed.
So I just want to repeat that one back. So for your principal place of residence, if you had a $500,000 mortgage, which if you live in Melbourne or Sydney is unlikely, right, you're going to go up about $500 a week is what would be the expectation there. And I would even say that's on a really good deal, right? I would say that it's probably going to be more than that. I even think on my own PPR, my rate is higher than that. And then on the other side of things, in the investing category, for every 500,000, the jump is about to go up about $700. Is that about accurate there?
That's about accurate. And then if you boil it down to, most investors will look at what their weekly rent is. And if we're going to go up by $161 a week, what have we been doing and what have we been preparing for our investment property? Or the reason that people take out fixed mortgages in the first place is this is probably the most unique area of time that when people come into my world to look at fixed rates, they want me to see what the crystal ball is going to do with the interest rate. And they want to take out a fixed rate so they can prevent having increases in their repayment if the variable rate goes up. Now we're playing that out right now. The variable rate did go up. So the people that did take fixed rates out are not paying the current variable rate. So they've played quite well. So investors that took a fixed rate, they've played quite well. We've just got to be mindful that it's going to come off. People that do take out fixed rates, they're going to come off. So make sure you're prepared for that. And you've played the game. So let's make the benefit of it and then prepare for the cliff. And cliffs are not too hard to jump up. You can get a rope. You can prepare your full drive. You can do a lot of things beforehand.
So that's where I want to take this conversation. And I want to ask some I'd love some insight from you first, though. You have quite a plethora of investors you work with, right? It's not like you work with one or two investors. You get to look inside many portfolios. How many of the investors do you work with are doing things today and preparing for this mortgage rate cliff? Like, is there awareness to what's coming high? Has the media done a reasonable job in going, hey, this mortgage rate cliff is coming and people are potentially looking to refinance? Or is there a huge amount of I don't want to say ignorance or neglect, but I'm sure you get what I mean here.
The media has done a pretty good job to throw lots of spanners in the works in regards to how to put a lot of fear out there related to what rates are doing, how you're going to pay a lot more. You might have to sell off everything and all that sort of stuff. So that's put a lot of fear out there. What I'm seeing with a lot of investors, not many of my investors are fixed. Some are. I've found a lot of first-time investors have taken out a fixed rate just to get used to a number. So the rate of repayment doesn't change. They might be first time getting into the market. They want to get used to the property managers, any maintenance costs, the change of tenants, change of lease agreements. They want to have that stability to be able to budget for this investment property. But in the main, even myself, I'm not even fixed. So a lot of people are just looking at how does this next property fit into my portfolio? How does the income balance work? And do I need a tax deduction or do I need something to add cash to my portfolio? They're not totally looking at the interest rate, even though it becomes a significant part. And you have to get the rate down as far as you can for the specific circumstances of the borrower. But that's what I'm seeing right now.
It's always interesting. I've been resistant to fixed rate loans myself, because I don't like the inflexibility that comes with them. Like when people hear fixed loans, right, it's like they think they're just locking in rate. I think a lot of people forget that you're also locking in the loan with that as well. And like breaking that loan, if you do need to do a refinance or change banks or whatever it is, can actually be very expensive. And I've never liked the risk that's come with them and have been, as I said, personally adversive, not financial advice, but personally adversive. Speak to a broker like Aaron who can help guide you on that. But I can get the appeal for someone who's like maybe a bit nervous and wants certainty, right? They want to lock in something for 5 years just so that they can get comfortable with being an investor or something like that.
Well, there's some stories around that one. Like when you're on a fixed rate right now, why do you want to break it? Like you've got a cheap rate right now, so you've got to really have some justifications to break it. And a few conversations I've had with people is that you might not be able to borrow with that bank that you've got the fixed rate with, which means your equity's locked away. And if your equity's locked away, that could prevent you making a move. And if you're wanting to make a move in this upwards rates interest rate cycle and you have the income, the stability in the portfolio and the right team around you, and you want to buy up an asset that's opportunistic, you may be locked up with that equity. there are ways obviously around that. Like if you've got a fixed rate and you want to put more lending on there, you can typically add a split to that loan at that same bank, but you've got to meet the bank's criteria to do that. So you can do that, and it's not an uncommon thing. We're finding a lot of artwork, or that art of mortgage broking is that we are trying to, where possible, hold the fixed rates in place because they're cheap for the client, make use of the next few months, get the next opportunity. But we've had to top up with the current lender. We've had to go into the battles that we do with the credit managers to get the right cash out, the right resources back out, so that you have the deposits and have the costs accommodated to buy that next investment property. But at times I've had people 2 or 3 months before their expiry of their fixed rate, because fixed rate expiries they're not a new thing. They've been expiring, and everything gets expired. There's probably more expiring today that we record this podcast of people's fixed rates coming off, and they're facing the cliff as we're talking about. And we might take an opportunity where the fixed rate's going to expire in a couple of months and go, nah, we've got an opportunity on the table. We'll just stop the fixed rate and go for that opportunity. And the costs associated with fixed rates right now, in the last 10 years, the break costs of the fixed rates have been quite large compared to the variable rate. And where you've got that switch, where you've got the fixed rate up here and the variable rate down here, you get a big break cost in that mortgage. And I've seen break costs where from a 10-year fixed rate being like $40,000, $50,000, $60,000. But right now, as the variable rate is higher than the current fixed rates, the break costs are not there anymore. And we're seeing that clients are getting letters from their bank going, hey, you can actually move on if you don't want this fixed rate. And I think that's quite an interesting move from some of those banks, because we've got to act in the best interest. If it's low, let's keep it low, but they are letting you move on where your fixed rate is a bit older than what it is today.
What makes this so interesting? And I know Grant's in this scenario where they're actually offering to let him out of a fixed rate loan. Of course they are, right? If they can move him from a 2% rate to a 5% rate, I would too. But it actually could be at his advantage, right? If he wants to make a move, to use your words there, and maybe refinance and get some equity out to buy another property, that could be actually really beneficial to him as well. Where that break cost, even if it was against his advantage, would just be another reason not to do it. So there are reasons to take advantage of that. Curiously, just a little quick one here, Aaron. What's the longest fixed rate loan you can get in Australia? Because I actually thought 5 was the longest, and you just mentioned 10.
Yeah, you can get 10s. I think there's not many people offering 10-year fixed rates at the moment. The maximum I see most of the clients looking and talking to me about, or even wanting to see what the differences are, because if the variable is going up, they want to see what the fixed rate is currently, is usually up to 5, but there are a couple of lenders that can do 10. Similarly, on the other side, related to interest only, with fixed rates too, is in the main, the fixed rate has to match the interest only term that you have as well. So if you want a 2-year fixed rate, you'll get a 2-year interest only. If you want a 5-year fixed rate, you have to match that to 5 years interest only as well. And those set of borrowers are going to have an interesting time as well, because their numbers are a little higher coming off a fixed interest only loan as well.
Completely. And there's this other fascinating part of this mortgage rate cliff that I'd love some insight from you as well on. Like when someone has a PPR, let's say, and it's their own place they live in, they go from this 2% rate to this 5% rate. There's no rental income or rent increase coming from that to offset it. So it's the household budget that gets impacted. It's the earnings on that household. Where when an investor has been hit with this potentially same circumstance, we're also experiencing like rent rises going up substantially. So they're not necessarily seeing the impacts in the same way. Now, this might be a question I haven't prepped you for, but I'd love to know, do we have any insight or knowledge on like how many PPR or investment loans are on this type of fixed rate thing? Do we see that it's going to be more something that impacts the households or the investors? Like, is there any knowledge around that?
Well, observations on a principal place of residence or your own place versus an investment. I don't have too much data on the differences of how many billions of dollars or the percentage of coming off fixed rates. I've got the global numbers of hundreds of billions of dollars coming off fixed rates, and even one of the major banks being $53 billion is going to roll off next year of the fixed rates. What I do find is the mentality of owner-occupieds versus investors is very, very different. So we talk about we need shelter, we need food, we need sleep, and we'll do everything we can to keep that safety for us. Or we can put it in Maslow's hierarchy of needs, if we want to get a little bit psychological there, is safety is our second to sleep and food and that level. So we're always going to find that we're going to be repaying our owner-occupied, even if it goes up by $500, $600, $700 a month, we will usually find a way. Or we might start to change strategy on it. We might go and rent out our current house and get rental income where there's a mortgage. Because still at the moment, we're finding that rents in some places, personal situations determine where that is that rents can be a little less, whereas you can get a mortgage paid via a renter. So there's a few different strategies you can bring into it as the fixed rates come off.
So just an idea there, if someone really falls into trouble, before they're going to sell their home, they might go live with their parents, for example, and then rent the house out. And they've still got the income from the job. They've now got this rental income. They're going to ride through this time and potentially be able to get back into the home. And then the second thing is, as you mentioned there, is because, I think the embarrassment and shame of losing your home is so high. The idea of that happening is that we would happily not go out for dinner or cut spending in other areas or sell our car before we would lose the home, right? It's something that's like the last line of defense. It would take a lot for someone to, cross over that barrier in itself. So really interesting points there just to consider on like moves people can make. The other one I wonder if you're seeing a bit more of, I imagine that if someone's had a house for let's say someone's had a house for 5 years, likelihood of having some equity in the home would be high, and potentially even the ability to refinance that home, pull some equity out and then use that as a buffer to ride through this time or to make other changes as need fit would be a strategy that could be done here as well.
Well, looking at some strategies to sort out this fixed rate. If you're not prepared, or you're partially prepared, or you didn't realize the variable rate was going to be up this high, things to think about is have you squeezed the bank as far as you can? Like, keep asking. I keep asking my bank until they say no. I've deployed some resources into my business to help reprice all my customers to make sure that we're squeezing them as far as we can. If you're got a 25-year mortgage, or even a 20-year mortgage, or a 15-year mortgage, there might be an individual personal circumstance that you might want to move that back to 30 years. You might want to increase the equity cash resources that you have to get through this time. You might have other things like rental increases, as you just mentioned. There's other costs to decrease. You might, if you don't need the second car, if you've only got your own place, where's your second car? Do you need that? The credit cards. Now, when the lenders look at things, all the buffers are not just at the headline rate. We talk about we're going to pay 5%, and then the banks are going to assess you at 8% because they got the 3% buffer. But it's all the other stuff inside. What is considered non-discretionary spending, private health insurance. Not that I'm advocating anything to change in that area, because that can be quite important.
Do you know what, Aaron? We're definitely not allowed to give financial advice. I feel even less qualified to give health advice. We should steer well and truly clear of that one.
So private school fees and private health insurance are over and above the living mechanisms with some of the lenders. Credit cards, some lenders will treat credit cards at 3.8% of the limit to 4.5% of the limit. So reducing credit cards, reducing other debts that you have outside the mortgage are going to significantly enhance what you're going to be able to do when you change from a fixed to a variable rate going forward. So it's not the headline rates or the borrowing that you have, it's what the buffers are inside the calculators. And that's where the competitions derive with the banks, because some will choose 75% of rental income. Some will choose 45% of your credit limit on your credit card. Some will take the actual repayments on your car loan. Some will have a buffer on top of that. And some will treat others' debts better than their own debts. So it's not just the headline rate. It's what's inside the calculator and what you can do to rein in your own expenses there as well. Offset accounts is another one. I love offset accounts. You can just throw a buckload of cash in there and save a buckload of money as well.
So let's unpack that a little bit more. You've just like a fire hose, Aaron. You've unleashed a bunch of things in here. So if you're someone trying to potentially you've got a fixed rate that's about to roll off. And now we're talking about the idea of like, what can you actually do with it? And the first one I come out with was the idea of refinancing. And you've really highlighted some things here. If you're on a 20-year mortgage, refinancing that to a 30 would actually bring down the loan payment every month. It would be good cash flow management. Yes, you would see some increased interest cost over the loan, but cash flow management for investors is very important. It could be the difference in keeping the portfolio in a healthy place. The second one you've go for it.
I was just going to say, with regards to loan term changes, like ideally we want to keep everyone's loan term where it is. So if you want to refinance your 20-year mortgage, it's ideal to keep it at a 20-year mortgage, especially if it's your own place and there's no other goal other than to try to reduce some interest rates. But if you can't achieve the hurdle of the buffers that the banks have and you have a specific need for it, there is a case to make to reach the loan terms. So just trying to keep it a little bit more on we should try to keep loan terms where they are, but if there's a need, let's move it back.
I'll give you another scenario here. Like that's a really good insight on that as well. For myself, I'm in a very fortunate position where I've got a strong cash flow portfolio and I also have a strong income, right? So cash flow today isn't as important to me as it has been at other periods. One of the things I've done, of course, with your assistance, I won't say I did it, you definitely did it, was the idea of going, well, I had some loans that were on interest only and I moved them to principal and interest and I was able to bring down the rate. In some cases, like it was actually like, I think 0.79, the loan came down. So almost a full percent, we were able to get the rate down just by making that change. Now, of course, I have to put the principal into the loan now, so cash flow changes a little bit for me. But doing that across my portfolio, I was able to actually make the portfolio substantially more profit, which tied into the second one there you said about like asking the banks for rates, like in that rate deduction. So that combination can be really powerful in this time as well.
It's an interesting thing with regards to even just some more changes related to interest only and principal and interest. And there's a lot of commentary around those particular topics. But 2 points I'll make here is that when your interest only is coming off a fixed rate, you can go from you're jumping up quite dramatically. So 2.69 fixed rate.
Yes, it became very apparent to me. I was like, whoa. It's intense, like especially if you were on that 2.69 and you went to 5 and it rolled off from interest only and principal. It's not a fun day.
So we talked about 2-year fixed rate principal and interest at 2.69 being $2,025 a month. An interest only fixed rate at 2.69, which was being offered, is only $1,120 a month. So it's already just under $1,000 cheaper if it was principal and interest at the same interest rate. And then if we jump to 5.69, we're jumping like a couple of grand up.
I was gonna say, is that like $1,500 a month difference? More?
Well, that's so the $1,120. So 2,025 minus the 1,120. That it's $905 at the same interest rate, at a $500,000 mortgage over 30 years. So when you jump onto the principal and interest, you could be jumping from $1,100 to nearly $3,000.
Wow. So that is near $2,000 a month difference.
That's right. So the people that are investors on an interest only and on a fixed rate, congratulations. It's great that you can save the money now, but be mindful of what you're going to do in the future. And also be mindful that prior to the last couple of years of low interest rates, we had the government intervention come in to look at reducing the amount of investor interest-only loans that were out there by changing the criteria that you actually have to service the loan at the remaining principal and interest term. So if you have a 5-year interest-only loan on a 30-year mortgage, you've got to achieve the buffers at 25 years, not 30. So they did a lot to reduce the interest-only loans out there, and that's proved in the statistics. So back in 2019, there was over $400 billion worth of interest-only loans, and today we're looking at around $285 billion in interest-only loans. So they did the job that they wanted to do, but just be careful when you are coming off those ones. That's probably where you need to think about what's going on. And the difference between interest-only and principal and interest, if it's about a 1.5% to 2% change, you're probably better off paying principal and interest anyway. And the other point is that with your investment properties, if you only wanted one investment property, paying principal and interest, after about 4 or 5 years, that property will probably maintain itself at a principal and interest repayment too, mathematically speaking. Not your investment strategy conversation, but mathematics. Usually around year 4, year 5 of a 30-year mortgage on an investment property, it should usually start to balance itself out because the debt's coming down, rents are going up, and all that nice jazz in between.
This is one of the parts where we're talking in the introduction about the art versus commodity type thing and like knowing these things. And we've had some really interesting conversations like at dinner and when we've caught up, Aaron, about just a lot of investors aren't aware that their borrowing power would be increased if they just did principal and interest loans rather than having everything on interest only because of what you just mentioned there about how they do their calculations on things post their own payments. Right, so that change alone could be the difference in you actually being able to grow a bigger portfolio, even though the cash flow impact is changed there. It really comes down to like, I'm not sure there's a right or wrong way specifically if you've got a portfolio strategy. Like I know people that have done well doing interest only. I know people who have done well doing principal or interest, but it's like you really want to understand the strategy you're following and what's right for you as the investor to hit the goals. Because my mentality has shifted. I was in that camp of like, interest only everything, refinance 30-year loans all the time. And then we were at dinner and you said to me, at some point you're going to have have something in the piece for, what did you call it? It was debt reduction strategy. Like at some point you're going to have to deal with this debt. You're not going to want to carry this into your 60s. And I'm like, I'm in my 30s now and I'm like, it kind of hit me a bit. It shifted my view in like, well, how am I going to do this and where does this strategy play? Like, am I going to grow a bigger portfolio and sell down some to deal with some of this debt? Am I expecting the properties I'm purchasing to actually pay their own debt? Where and how? Am I going to use business profits or income from other areas to pay down this debt? Like, how's this all coming to be? And it's a part where I think the exciting part of being a property investor is going on the run, right? It's the accumulation phase is all the fun. The consolidation and how you're going to manage your debt, whatever your strategy is, not very oftenly talk about. Not as sexy.
And it's not as sexy. How many shows do we pull up on YouTube? And I know we're both fans of looking at property podcasts and business podcasts and things like that. But do you know the best way, one of the really easiest, logical, mathematical ways to increase your borrowing capacity is to pay down the debt? I don't think it's talked about that often. And yes, we've got interest only and principal and interest, but right now in a raising interest rate market, and I've remember presenting 5.5% interest rates when I first started as a mortgage broker back in 2012, where everyone come, oh, that's a really awesome rate, 5.5. How did you get that for me? Great. And now I'm presenting 5.2s and 5.1s and everyone's like running for the hills.
The perspective's interesting, isn't it?
Yeah. And it's one of those things, interest only has its means and its use. If you're accumulating, it can help you get that principal back to add as a deposit. It can be really cool in an accumulation phase where you're able to jump over the hurdles of the lender that assesses on remaining principal and interest term. And it also can help you when you got non-deductible debt, like your principal place of residence, but you've actually got to move. What is that? How many times does someone talk to you about, let's take your interest only loan for your first investment property, but you've actually got to think about the $500 that you're saving by paying interest only, and you've actually got to get that $500 a month and actually put it off your owner-occupied property. How many people get into that level of detail to go, that's what you actually have to do? And when you get your tax return, and you've got all the other mechanisms in there and you've got all this money come back in your tax return, that's not for you to go and put a new kitchen, bathroom or anything in your house. That's actually ask your accountant, what was specifically in my tax return, if I'm PAYG or self-employed, what is the return that you get on your personal side? What was the effect of your house, the investment property versus just your donations or motor vehicle expenses or working from home stuff that you can get and claim? What was the percentage that you can put back into your lending? And if you can put that back in your lending, say it was $5,000, $12,000. If you got $12,000 and you put that off your primary place of residence, your borrowing capacity could skyrocket if you keep doing that over and over again. And as you got rid of your own mortgage, what if you could get rid of your own mortgage and now you have that 2, 3, 4 grand a month that you were paying off your mortgage to now accelerate your investments?
I concur. I really concur. I find it really fascinating. The big sell in going interest only for a lot of people is that, well, if I'm not paying principal off the investment, I'm keeping the tax deductible debt and I can utilize that potentially on my own mortgage. As to your point, though, how many people actually follow through with that versus use the cash for other things? I'm not so sure about that. But I want to come back to the mortgage rate cliff, Aaron, because I think this is something where laying this all up, and I feel like we could do a whole episode on like loan strategy and debt reduction strategies, which we probably will. I think it's a great idea. What do you think the impacts of the mortgage rate cliff are actually going to be on this? Because I'm hearing a lot of whispers from you in the idea that a lot of people are getting prepared already. Awareness is high. I can't see the property market collapsing on the back of this because of the idea that many people would prefer to live with their parents than lose their home. A lot of people have equity after the run that's happened as well. Like, it's not as potentially as dire as people think, or maybe you think it is. So what do you think potentially is going to occur here?
Well, we've got the doom and gloom out there to help people prepare. Don't take it as doom and gloom. Just take it as a reminder that you've got to prepare for you're going to have to scale a cliff and it's going to be overnight. Number 2 is that we've got the concept that we unpacked a little bit before. You might want to revise your strategy on investment. You may need to, whether it's putting a tenant into the place that the repayment's going to go up, that you don't have a tenant to help and you might want to rent somewhere else. You may have to do a bit of a swapsy, or I don't know, over this time of period with my kids, we play a game called Go Fish. I'm not sure whether you've played that, and you go, cool, do you have I think we play the one with Bluey. Do you have Bluey? And my daughter gives me Bluey, and that's swapping the strategy around. You might want to, I might want to sell you one of my properties, and you might want to sell one of your properties to me. Like, there's going to be this Go Fish swapsy individualized strategy going to go out there. So that what suits.
Can we pause on that for a second? I just want to unpack that. So you're in the idea, let's say someone's been massively into negatively gearing. This might be the time they swap a negatively geared asset for maybe a commercial that's got a positive cash flow experience to kind of balance out this in their strategy if they believe rates are going to remain at this level or even potentially go higher. So asset swapping could be a potential thing someone could look at to deal with this mortgage rate cliff in itself, which is an interesting idea.
It's really cool, from a game that you play with your daughter through to property investment strategy. I think that's a really interesting thing.
I did admire you brought that together. We went to Go Fish Bluey style, which I'm sure Jack will love. I might have to get a deck. But point being is that that's an interesting concept in itself.
And getting rid of lower yield properties to buying higher yield properties is probably that concept that you were saying there. Commercial can be a different kettle of fish altogether. But yeah, having the right yields, like you've got to cover your day-to-day expenses. And that's where the yield comes into interest rate. And there is also a subset of people that probably need a tax deduction as well. If you're high income earners, they might be able to afford the $4, $5, $6 million property in the middle of Sydney or Melbourne, and that could be quite advantageous for them to buy with the cooling off a little bit of the market to get a bit more of a bargain. So there's always people that are out there buying. There's always people that need to readjust their strategy, whether it's renting, whether it's selling, whether it's swapping properties from Bluey to a Go Fish, traditional style. So that's where I would go.
Do you know, that's so interesting, Aaron, is where I did really well in property is that in the very early stages of the pandemic, I was a buyer when people were sellers, right? People wanted out of the market because there was genuine fear that the world might end. Noting I had some of that fear as well, right? I actually thought this could take down the world. And I decided that I would rather go down with as many properties as possible than live in fear. But the point being is that when there is doom and gloom around, it actually is the opportunity as a buyer, provided you're in the position to do so. And it's funny you mention it because that's actually what I'm deploying now. Like for myself, I am being a touch opportunistic. If Melbourne and Sydney keep taking the hits they are, and we end up with some very motivated sellers because of this mortgage rate cliff in this example here. Like, I want to be ready to strike. Like, I'm not seeing this as a doom and gloom. I'm seeing it, well, if this is what's going on, this is buying opportunity. Where if markets are booming and all the news is good, maybe I need to reframe to selling opportunity or being more strategic in the plays that can fit, right? I mean, what is it? Right season, right strategy?
That's right. And if you boil it down, like if you're buying if a brick is worth $1, but the price of the company's up really high and the company price on their share comes down, they're still selling the bricks at $1. Like, it's really interesting how you can look at the metrics behind things and what is calculated and what is not. What influences does government have on different areas? Like, we could make a wild prediction here and go, well, the data is calculated and then they change how the data is calculated. If we look at percentages and we look at surveys that don't survey 100% of the population, we can interpret the data a whole different way, and the emotion put onto it and how we react to it is different. Like, if I'm running late to a meeting, do I just get really angry that I'm running late, or do I take the opportunity to make another phone call and sort out another customer? And that's the same with the government. Like the RBA, I feel like and probably right to say that the governor of the RBA is actually appointed by the government. The data around inflation and things is what's included, what's not included is around the public service and what they're putting in and what advice they're getting. So that's a really interesting thing about, do we think interest rates are going to keep going up, or they're going to come off, or whatever else is there too.
Totally. It's interesting, right? It's like clearly the government doesn't want property to crash. You only have to look at how many government employees own property. It's really interesting. If you look to Parliament, I think it's on average, each member of Parliament owns 2.6 properties. And I'm like, that is hilarious. So like incentives, we'll look at it there. But the general nature is they don't want house prices to fall. But then to take it further, they also appoint the RBA and decide what's calculated in inflation and assign spending and stimulus in the economy. It's like the incentives are very, very interesting. We'll leave that word there. What you're alluding to, though, is that based on these perspectives, and there's two that really come out, as like investors have options. There's still buyers out there. You can refinance. There's things you can do. Like this interest rate sudden cliff hit isn't like everyone just has to take it. There's things you can do to embrace for this impact or scale this cliff as you go through it. Do you think that on the basis of what we're talking about here, though, there's the potential for this mortgage rate cliff to push the country into recession or see any more massive downfall or a big downfall at all? Or do you think that's just been exaggerated?
Well, we've got some recent history to think about here. And I'm only talking the last eight interest rate rises. And we started the onset of the podcast about variable and fixed. And that's where we've got this cliff coming in, that the fixed rate will go up. But all the people that are on variable rates have had to pay the extra money right now. And I haven't seen any exuberant pay rises. I haven't seen exuberant in the general nature, specifically individually and skill-based. I'm seeing a lot of people getting a lot more money, and I'm seeing a lot of the 2022 tax returns on self-employed being very, very strong coming out of the pandemic. So there's ability to overcome the buffers of the banks. But people in the main that haven't had any changes in wages and stuff are actually paying the variable rate now. So that's an interesting thought to think about. So yeah, you might be sitting back as a fixed rate investor, owner occupier, watching your colleague who has a variable rate pay more and more and more each month, but they still pay it. So, and you didn't take a fixed rate out just to think that it's going to be there forever. It's going to expire. So you've already had to think ahead on that one by actually taking that product. So there are people that are going to be unprepared. There are people that are going to be prepared. And there's people that are going to talk to their colleagues that are on variable rates that have actually had to pay it. So I feel like we're not going to see the full effect of all the interest rate rises for many months to come, even if not 12 months to come, before they see what happens to inflation, looking at the history of that data. But I feel like we're not going to go, my gut says not going into a recession. My gut says we're going to go a little bit more individual and see how we can fix people's portfolios via lending or other mechanisms there, renting, selling, consolidating, swapping, all that stuff. I don't think recession's there.
Interesting. So your general view is this isn't going to be as a big event as some media outlets would lead us to believe in general, based on your thesis there. I actually tend to agree with this. I think there's too many tailwinds for property. And to your point, if it was going to crash substantially, surely what we've seen so far would have done so, right?
Yeah.
I would have expected bigger drops to have occurred in the rate rises we've had, right? Because the psychology of the market has been bearish in general, and it's like for it not to have fallen further would indicate that it potentially won't. Again, this is speculation, pure speculation. Do not take your thesis out about what Charley and Aaron say on a podcast. The other side of it is I see a lot of tailwinds with immigration. I still see a lot of hungry buyers out there. Like I'm very fortunate I have insights to many buyers agents as well, and they're still got many clients coming on board who want to buy property. They're not seeing a slowdown in investor demand either. And I suspect you're not seeing a slowdown in investor demand. I'm sure you're seeing people, I believe you even said you have a settlement today earlier in this episode. So it's like, it's happening.
So, and that's the strange thing this year. We are sitting at the 30th of the 12th, 2022, and even between Christmas and New Year, we're seeing settlements and we're seeing restructuring of lending, and the majority of that has been investors that has just lagged from before Christmas to after Christmas, and that's a big interesting area. We're still seeing a lot of purchases go through. Like we've got cooling off periods running off on people buying properties, and cooling off obviously being the due diligence area of making sure you're right to exchange and be approved in the loans. We're having that expire over this period of time as well, where normally banks are going on the skeleton staff. Like most people want to have a break and spend time with family as well. So doing that settlement, I was standing in a furniture store, just sending a text message to confirm that my client was all good to go.
So I'll finish with this question here, Aaron. I mentioned earlier in the episode that personally, I'm being opportunistic at this time. I'm actually kind of hoping for a little bit more fear in the market, some great opportunities to buy, and I would love to buy a property in the first half of 2023, a really well-priced, good asset I look back on and go, damn, that was a good decision. But you're also an investor. You're not just a mortgage broker. Right? You're also plenty of other things as well. I will say that as well. Father, husband, all those things. But what are you personally doing? How are you playing this yourself? Because I think this is a really big indicator of are you drinking the Kool-Aid, or what is Aaron looking at?
Oh, so I'm currently I've got a property that I'm constructing. So let's just not make it something that I'm going to settle on.
Are you sure you don't like self-punishment at this point? I feel like anyone doing development or constructing in this market, wow, you must like.
So I should have a slab down in going into January on my investment property, and I've taken an approach that I want, and you could probably say that I'm a bit bullish, like eight interest rate rises, and here I go, I'm going to buy an investment property and I'm going to construct it so I have 6 to 8 months without a tenant, and then I'm going to wait for that, and then I'm got all those other things that happen when you do construction, but I'm playing that game I do chunking in my own portfolio because I've got a business, I've got a family. Like I'll buy a property, then I'll double down on getting the income up, then I'll buy another one, and then I'll double down. I'll buy another one, double down. And that for me personally allows me to scale up all the areas of life to be able to accommodate what I want to do. Because I learned early on with investing is that you have to understand the lending metrics first and the calculators first. And it's nothing to do with loyalty to the bank. You've got to meet their calculator. And it doesn't matter how long you've been with the bank, you've still got to meet their calculator. So that's where it is. So for me personally, I'm constructing my investment property at the moment, and it's going to be awesome. It's going to be a bit of a ride, but it's going to come out the other end, and it's going to have a great yield, great ability to add to my portfolio from there, and it will spit off some cash even in this interest rate environment to help me even pay down my own debt. Guess what? My mortgage interest rates have risen too. I'm paying a bit more like everyone else, so I might get you in a mortgage, but I'm there. I'm doing it as well.
Well, there you go. We might even do a potential episode on going through that process of getting land and building in this time and developing. I think it would be really interesting to understand what it's like and been like with all the challenges that have gone on with rising costs, supply chains, interest rates, doom and gloom, the works. But before we wrap this episode up, Aaron, if someone is looking to refinance or potentially needs some help with strategy around how to deal with this mortgage rate cliff, or if they have a fixed rate loan, what's the best way they can get in contact with you?
Well, the cool thing is that the broking firm, Diagnostics Finance, that I run, we have 4 other brokers and a support team to be able to help you when you need it. And the best way to contact us is there's through the propertyinvesting.com website, and also through my own personal website, d8ndf.com.au, and we can help you out from there.
Of course, I'll make sure to include links in wherever you're watching this episode. But a big thank you for coming on the show today, Aaron. A really interesting conversation. I'm sure you'll be back on the show soon to talk about some of these other topics. That's it for this episode of Property and Investing. As Grant would say, something, come and join the email list. Opt in below. There's probably a newsletter with this episode. Anyway, it's been nice to have you on the podcast. That's it for this one.